Thanks very much, and good afternoon. Likewise, we've got a booth out the back, and we've also got some presentations on the back table there if you'd like to take them the way out. Not got long, 10 minutes. I know you've seen a bit of Trinidad today. Just to say that it's 6 miles from Venezuela, but that's about where the similarity stops. You've obviously got big players, Shell obviously taking out BG up in the north, and the south east here. BP, massive player. And then the National Oil Company, and then some of the smaller players onshore. It's a little bit like Texas. It's got everything. From ultra-deep water drilling out here where BHP are exploring through to small onshore players. But like the North Sea was 20 years ago, it's been very much dominated by those big players for a very, very long time. And so therefore there is still a very large stranded reserve base. Our acreage is highlighted in blue here. So we're off the east coast, we're onshore, off the west coast rather, east coast, and off the east coast here. And there's been some deals as well. Obviously Shell took out BG. Perenco have just taken out Repsol here, $250 million deal to buy 14,000 barrels a day. And they surround us at Galeota here. More about that in a minute. So deals are happening. And obviously on the back of that sort of development and historical story, there's a great supply chain. You can get anything you want in Trinidad. As a company, we are 100% Trinidad focused and managed. I was born and brought up there as well. My father was a doctor there for 40 years with Texaco. So our people come from great backgrounds. Our board is pretty small, but again, comes from commodities trading, broking, upstream and accounting. And the board and management of Trinity own over 25% of the company. And if you take friends and family into consideration, it's about 40%. So hopefully we behave as shareholders. We're very commercially and technically focused. I'm a geophysicist by background. Our production, we've got quite good critical mass, somewhere over 2,600 barrels a day right now, focused across both onshore and offshore licenses, in nine licenses and multiple reservoirs. So we have portfolio within our reservoir group and 21 million barrels of 2P. And our sense check is we produce between 5 and sort of 7% of our 2P reserve base every year, which is a good sense check. And we're very profitable. 28 all in, underline all in, because it's not always defined that way, but that includes OPEX, G&A, and royalties. This is the graph, the only one you really need to see. This is this year. We came out of a restructuring back in January. Took us a few months to put together our plan, upgrade some facilities, and get our approvals in place. And we've taken production from about 2,450 barrels a day to closer to 2,700 now. And we haven't drilled any wells yet. We're just going back and picking the low-hanging fruit, squeezing the margins and getting our operating efficiencies up. You can see we had a storm that came through, and that was the actual effect on our production. 80% of our operating costs are fixed, so nailing our operating costs leverages ourselves financially, which is very important. This just shows what an RCP looks like, one of our main activities right now. So in Trinidad, you've got to go to deeper sands, complete those. But quite often there's bypass pay. We run different algorithms using different software to get old resistivity logs looking like modern ones, basically. And we find these bypass zones. We started that in February, the first well. We've now done 30, which goes beyond this graph. We're averaging about 170 to 200 barrels a day from this program. We delivered 18,000 barrels in the year so far from it. But phenomenal returns. These RCPs paid back in 8 months. This includes 3 failures that we had as well through to well issues. And a PV we're adding of 120-odd thousand barrels a day and huge, great bits of return. So we are focusing on the low-hanging fruit to drive those returns and grow the business. On our profitability is the waterfall here for the first half of the year. Turned over just over 20 million barrels, if you like, and our EBITDA, 5.5. It's a margin of 27%, and that would really rank in actually any industry that you look at there. And I think energy overall, globally, the margin's about 7 or 8%. So we've got to keep disciplined and stay on that. And we are consistently profitable. But this has come about through a huge amount of work and cost cutting and renegotiating our contracts, etc. Keeping that margin there and our financial resilience. So EBITDA, first half of last year to this year went from just under $4 to $13. That was a result of oil price increasing, but also of us keeping our cost fixed. 4 or 5 years ago, our G&A was $14 million. It's under $4 million now. for instance. Our operating break-even, these are fully loaded operating break-even. Royalties, G&A, and all operating costs. Onshore, $16. Consolidated, 28. Offshore East Coast, 23. We've just sold this asset to Range for $4.5 million. So I won't talk about that. It's going through its approvals processes. Basic OPEX, just over $10 onshore, which is less than half of our competitors. And consolidated, 16.5. And G&A, flat. This I just like to show. It shows them we were fat and slow, and now we're lean and mean against the oil price, and just demonstrates the margin that's there. Just looking at how we rank. So this is just taken from public information last year from this peer group. That on a EBITDA basis last year, they all lost, averaging 10 million per barrel. We were just over 5 million positive. And this year, and on operating costs, again, we were $16 odd compared to our peer group of 27. And this is where we are actually today in terms of EBITDA per barrel and operating costs per barrel. And if you take out just our onshore, as I said, we're 10 to compare to peers, because most of these are just onshore players. It's $10 versus sort of 20. Now we've got our East Coast asset is a big asset, and I just spent a little bit of time on this. Basically, going through our restructuring, we were driven to warehouse this asset. So we took over Bayfield, and that didn't go very well, and that added to our problems 4 years ago. And our problems stemmed from production down at Trinity here. The market really hasn't seen this data, because we took 2 3D data sets, reprocessed them in Germany, and built one consolidated new data set. And then got an ex-BG group, generally, of subsurface scientists to remap this. So that's an anticline that's in our license, and it's about 14 kilometers from one end to the other. If that was full to spill, that would be many, many tens of billions of barrels. It's not full to spill. What we find, we've got 6 sands throughout this asset, and when the oil column in the sand gets to 300 feet, it breaches the top seal. And it's quite a common phenomenon in this part of the Columbus Basin. So if you take the top 300 feet of every sand within the anticline area, we map 700 million barrels in place. And that is also confirmed. All these wells I've got along the crest here have drilled and tested hydrocarbons from those sands. We map at Trinity area, where we're currently doing 1,100 barrels a day. We map just under 250 million barrels in place. That's produced just under 30 million to date. So it begins to make sense in primary depletion. We're getting up to the 13, 14%, and that'll probably go to 18%. So the numbers where we're at and the observations we see in our wells, it all makes sense, where it didn't in the previous models. Teagal is the exploration well we drilled that was on the very first slide. We map 186 million in place. These blue dotted lines segment one from the other. Teagal 2 just stepping out another few kilometers, 68. This terrace down here has never been tested, the top 300 feet of closure. There's one well down dip, and it was wet. Again, we can drill this from our current platforms. So we've got a lot to get after here. What we have to do, though, is work out. We have a field development plan. Draft is in place. So there's not much work to do on the subsurface and reserves. But now we're looking at how we'd actually go and develop this. And more than likely, it would be like a bare-bones jack-up rig, bought in the US. Many of them are stacked, but with no drilling capability on it, and tow that down and use that as an early production system. We have our own rig offshore, which is currently being backloaded to the onshore to get refurbished and put a top drive on it. And we would like to get back out drilling, first of all, at Trinity in 2019, and then to get to develop Teagal 2 area, and the Southwest Terrace in 2020 onwards. And those wells are 800 to 1,000 barrels a day type production. Going forward, we more of the same. We think we can take this year's average production to next year and grow that by 10% through our onshore program as we continue to work up the offshore. At Trinity, though, we do have some RCPs to go back and do there when we're ready. We're just doing some upgrades to cranes. And a Galeota, take it forward. Maybe we want to farm down a bit of that, take some cash off the table, take a carry forward to first oil on that. But we will work on that over the next 8 months. In summary, then, we are a significant and low cost base, very profitable producer. We're a little bit unusual name. We're sort of a more comparative, I think, to sort of, the Sercos and the Pharaohs of the world, really. We got a near-term target of 3,000 barrels a day. We think we can get to that pretty quickly. And it all comes from within our portfolio. We haven't got to do more deals to continue to grow this business. We are profitable, we're resilient, and we're disciplined. And I did notice Peter, in the very first panel session, said that nobody can make any money below $30 a pot unless you're in the Permian. Well, we can, and we do. Thank you very much.